Hello, good morning, and welcome to another episode of Two Great Beards. Today is December the 16th, and the year is drawing to a close. We had a very interesting week last week, didn't we, Andy? What did you think of it?
Well, sure. The long awaited Fed meeting and inflation data, the outcome was a violent move in the short term interest rates in particular, and a move in all assets, in particular, the long bond, the 10-year note in particular, rallying is with the short end. And, the vibe from me after the meeting was very clearly, if not mission accomplished, certainly we got this, folks. We're going to land this thing softly.
Yeah, certainly. The Waller narrative keeps on progressing, which is basically that they will lower rates when possible to keep the real rate more or less constant against inflation. What that spread is, and it's anyone's guess, but it seems to be roughly around the 2% area that they want to keep Fed funds rates for now above, core inflation and manage the economy that way, which is, a departure from what they could do, or maybe even some people say should do, but that certainly seems to be what the market is pricing in.
Yeah. So, I think I agree with everything you just said, but you also can't look at the market and believe that that rule that you just described, which places the Fed funds rate based on their inflation projection at 4.6 for year end, for 2024 year end, you can't also hear that and look at what the market priced it in. And the market priced a 3.9% year end interest rate. So there's a huge discrepancy, and so there was a discrepancy between what the Fed had been guiding with their rhetoric around this idea that Waller talked about of a constant real interest rate, but the market on the news that but the market didn't believe that. The market didn't believe it by between 25 and 30 basis points prior to the meeting. We got confirmation of the fact that they were going to use this approach, and the market believed them even less, meaning there was a 25 basis point, we don't believe you premium in the number of cuts that were being expected going forward. And that's now at 60 to 75 basis points. So the market took this mission accomplished view and aggressively priced 145 basis points of cuts into 2024, despite the Fed confirming their view that it was going to be 60 to 75 basis points of cuts.
Yeah, but we all know that basically the market anticipates, and I think that what they were probably looking at was the projections further out for 2025 and then 2026, where they have core PCE down to 2.2 and finally 2%, and the Fed funds rate going from 4.6 in 2024 to 3.6 in 2025, and then 2.9 in 2026.
Right,
and therefore,
they're essentially 9 months ahead, assuming
right,
that the time.
right. So what they're doing is they're anticipating this path, and correctly, my view, and that is what we actually did, they decided to aggressively buy the belly of the curve, the 3 to 5, 6 year area, and anticipate this descent in Fed funds. Now, one argument one could make is that there's a lot of money on the sidelines and a lot of money in money market funds, which now has a lot of reinvestment risk, because you've been getting 5.25%, and now you're afraid that suddenly that might come down quite aggressively over the next couple of years, and therefore you need to start shifting that money from money markets, just like we did. What did we do? We sold the USFR floating rate note and we invested it in the belly of the curve. So there's a lot of money that could do that, and that is why the market is behaving this way. Does not mean the market is right. In fact, the odds are that the market is going to be very, very wrong in a year's time, that the outcome is going to be very different. It could be that inflation is far stickier than we think, and it might even reaccelerate, in which case the pricing is going to be completely wrong. And also, it's perfectly possible that the economy is far weaker than the Fed anticipates, and inflation is actually lower, in which case the cuts will be even faster than the market has discounted. But that is probably something that we won't know until real data tells us in quite some time.
Yeah, and I want to just come back on the idea of money on the sidelines. That money in the money market funds is pretty sticky in terms of what the end investor wants out of their investment. So it's pretty unlikely that a majority of that money would seek out risky assets. But even if they did, the 2-year note already reflects this short-term money no longer paying the high interest. So if you move money now from money markets to 2 years, you're locking in an unattractive rate path. So we like the 3 to 5 area because by the time you get out to there, the cuts priced in are zero for the back years. And so there's a bit more attractiveness to us for that part than, say, the 1-year bill or the 2-year note, which just don't reward you versus cash. But anyway, we moved out of cash to a place that we think is relatively safe, given the inflection point and given that we also own equities.
Yeah. No, I completely agree with you. Somehow I feel that this is a very important inflection point that we will probably not get an answer to for maybe a month, maybe 2, maybe 3. But I certainly feel that what the market is pricing in at the moment is probably the least likely of outcomes. I think that either we're going to get a recession or we're going to get something that is the opposite of that, i.e., an economy which keeps on trundling along at 1.8 to 2.2 in terms of GDP, real GDP, and an unemployment rate which is very sticky around 3.7, 3.8, which is probably not going to allow the Fed to do any cuts until the very latter part of next year.
Right. And I think that's been something that we both have been saying for this entire year that we've been showing up and in front of you on Saturday afternoons, that the equity market is pricing a different outcome than the rates market. And I would say that, and maybe this is why we both think this is such an important inflection point. I would say that at this very moment, that, and we've been following this for this, well, we follow it all the time, but we've been following it and mentioning it to you in particular over the last year. The discrepancy between what equity markets are pricing and what bond market, short-term bond markets in particular, are pricing, and what gold is pricing, and what commodity markets are pricing, has never been as large this whole year. And so that means both that the market pressure for this inflection point is at an extreme level. But we won't know until either forward-looking data or the actual data convinces markets which side of this inflection we're going to end up.
Yes, and I think that's very important. But the highest level point I would say is that we are fortunate not to be running billions and billions of dollars, and therefore we can afford to wait and react and be balanced like we are in our portfolio. So neither outcome is going to really hurt us, and that is the point of Two Grey Beards, to be balanced until the data tells you which way you need to jump. And when that happens, we will jump. But at the moment, probably nothing much to do. Just where we are is the most sensible place to be.
Yeah, I mean, if you look at the portfolio, just to put some meat on it, we bought uh, real bonds, 3 to 4 year bonds, and we have this VWAB, which is a high interest rate, relatively short, less than 6-ish years duration bond. The potential for in where how would bonds hurt you in this inflection? Bonds would hurt you if the Fed didn't cut. But our 3 to 4 year bonds are going to pay you back your money in 3 to 4 years. They're not going to extend in duration. They're going to pay you back. And so your potential for capital loss on your is very close to cash in these 3 to 4 year bonds. So your downside is extremely limited. Why do we own them? We think there's the possibility in a recession that they earn significantly more than cash from a capital appreciation standpoint in the next year or two, and from a carry standpoint. But really, that's just an extension. What I could consider it is an extension of cash with some upside, with very little downside. Our equity exposure is the opposite side, which is we're medium sized in equities. We're nowhere near our peak and we're not at our low. And the reason why is we don't know whether we're going to have a recession or we're going to have a continued meandering along of the economy. And so unless the economy ignites without inflation, equities are going to do, we're not going to miss anything in terms of capital appreciation on equities. It's possible if the economy ignites without inflation that equities does extremely well, but unlikely that occurs. But our 30-ish% holding in equities should do fine on the upside because we think there's limited but some upside in one side of the scenario. On the other side of the scenario, there's significant downside. And so we're nowhere near our maximum size. And that scenario is when our 3 and 4 year bonds pay off. So that's what we mean by balance.
Excellent. The only thing that we haven't mentioned that happened last week was that the one central bank which can afford to be dovish was actually hawkish, and that's the ECB. Probably hawkish is the wrong word, but certainly much more reserved than the Fed was. And the market just didn't believe them. It just, it came back a few ticks and then went again the next day. So the markets are definitely in a jovial mood and they want to buy bonds aggressively on any basically retracement. So I don't see that changing until the data changes. I think retracements in bonds are going to be very, very limited until data allows it. And equities, actually, what we need to say is that equities are trading tick for tick with bonds. You're trading the same asset. You're trading the same assets whether you trade bonds or you trade equities. So there is an argument that our 50% allocation in bonds and our 36% allocation in equities is actually an 86% allocation in equities or an 86% allocation in bonds. They are literally trading tick for tick.
It sure seems that way. And that talks to the nature of the market right now, which is very well driven by animal spirits and flows of major capital like QE and the treasury issuance. And that's really dominated. If you look back, and we can put this graph on the website, if you look back, if you bought bonds in July, or if you bought equities in July, you would have had a drawdown in both through October of 10% and a recovery of 10% since then. And you would have experienced that drawdown at exactly the same time. They were, I don't know that British expression, tit for tat, owning the same thing. So the question is more of that on the way, or are these things going to diverge? Is owning a bond and owning stock going to stay the same like it has in the last 5 months, or are they going to diverge? And until we know, you own some of each.
Absolutely. And personally, I'm keep on looking at commodities and gold, and they're just not catching a bid. And that would tell me if they were catching a bid, that would give me a clue about real data coming, going forward, and also which way the economy is jumping, but nothing at the moment. So I think the best thing to do is to be diversified and wait at this inflection point, and we will know which way it inflects in a couple of months' time, I would have thought.
Right. Market prices on commodities, gold, and bonds and the dollar are all looking like recession, and equities, credit, anything to do with a company, spread product, mortgage product, all the products that have idiosyncratic risk are all expecting a muddling through. And that's the divergence, and it needs to resolve. And we'll be looking at prices, and we'll be looking at actual economic data. One idea is a big NFP. When payroll falls, one side might get picked. If inflation has a second wave, the other side might get picked. We'll be looking at prices and data and looking for when that inflection actually starts to matter.
Yeah. I think it's unlikely to happen next week, though, Andy. All we have is core PC on Friday, which is unlikely to be a surprise to the upside because commodities, oil in general, have been very weak over the past month. So it's more likely to be below expectations than above expectations, in which case we will get more of the same, more bond rallies followed by equities tagging along with it until, we get the Santa rally at year end and not much is going to happen. So that is all we have to look forward to next week. And the reason why I think no portfolio changes at the moment are warranted.
Yep. And we'll see you, I guess, on the 23rd before the holidays. I assume we'll have an episode.
We shall see if it's needed, but certainly on the 30th, which is the last Saturday of this year, we'll certainly have an episode and basically look back on the year that was and see how we can help you in the year to come.
Indeed. Happy holidays.
Happy holidays. So after the emails that we sent you on Wednesday, this is what the portfolio looks like. 36.6% in equities and 50% in bonds. These are the bonds that we bought, the 4 1/4 of September 27 and the 4 7/8 of October 28. So we are in, 4-5 year area, the belly. This is what we like. And as we said, this is the one we like least, the shy, the 2-year area. And that's why in the order entry, I have written what I have written. If in the next few days we see an opportunity to sell shy and buy SPY on a 1-2% pullback in shy, we might pull the trigger on that, but we will definitely send you an email ahead of time. All the broker statements are updated. All you need to do is download them from these links. And the monthly performance is also updated. I've actually linked it so that we have a month to date and the year to date performance. Please do also have a look at these investing rules and objectives. I think it's important that you should know what our objectives are and how we aim to achieve them, because we are not a hedge fund. This is not speculative trading. And if you ever feel that you wish to be more aggressive than we are, by all means, that is your decision. We're just trying to show you how to run a very balanced portfolio, which is going to have low drawdowns over the short and medium term, but still compound at a rate which is perfectly acceptable, well above cash. Thank you very much indeed, and have lovely holidays.